Hello everyone, my name is Nrupin and in this video I will try to explain investing method of our favorite investor Sir Vijay Kedia. First of all, I would like to clarify that there is no written book or video course specially created by Vijay Kedia himself to teach his investing method. By the way, I have tried breaking down his investing method based on his interviews and lectures that are publicly available on YouTube and websites of news channels. Vijay Kedia's investing method more of advocates investing in management of business and not in business itself. He says good management in bad business is better than bad management in good business. As per him, good managements can make business work even when whole industry is suffering from turmoil. As example, he explained how airlines sectors are in shit everywhere while Indigo is printing profit. His preferred businesses are those which can keep themselves safe against turmoils of its own sector. From it, we can conclude that Vijay Kedia is more of qualitative investor and not the quantitative one. He recommends not to completely depend on market as your source of income. Always have an income source outside of market. Always save from your income and invest part of savings in market. Again, he advises not to invest on borrowed money. Market is risky place. There is no guarantee that money invested will surely turn into fortune. So first, you must have savings. Second, you should only invest part of that saving. And third, do not invest with borrowed money. As per him, you should invest for 5 to 10 years and do not expect better profits before that time. If you make profit early, it is totally luck factor and you should not take credit for it. Always invest with best management and let them worry about growth. You don't need to worry about growth of business. Do not worry about bad times because good management adapts to all bad situations. You should not bother about your investments. Let the management of business bother about them. If management is really good, they will make sure your investment will flourish with their business. For him, three things are important for successful investing. First is knowledge, second is courage, and third is patience. He says if you have no knowledge and no information about why you are investing in a business, then you are not investor but a gambler. Knowledge is required to invest in stock market. No academic degree can help you succeed in market. You can only become successful by practice. Stock market is not place for easy money. It is place where you work hard to make right moves and other live in delusion that you are making easy money. While learning, you might think it is very easy to find and invest in stocks. But while applying learned information, you will realize the easier method will sound, the harder it will be to apply. What's really easy is least likely to work in market. Next, as per his experience, market faces scam every 3 to 5 years. New rules are made to patch loopholes after scam. Still someone manages to find loopholes and creates another scam. Your investments can suffer during these times of market. If your purchase price is low, then you can face turmoils of market. But for bad time passes, you will need a lot of courage to hold your positions. Finally, patience is required because market makes money for you only in long run. Market crashes are inevitable and they happen quite often. But every time market crashes, it also recovers multiple times of crash. In such cases, patience is only thing that will make profits on your investment. Now since Vijay Kedia invests on information, he reads like 10 to 15 different newspapers every day. Apart from that, he keeps eye on interview of CEO of businesses. As per him, news informs you about revival of sector long before revival actually takes place. Again, rather than just reading news, you must also be able to connect dots provided by news to reach right conclusion. For example, if you found news that in some country demand for some food product is going high, then you should be able to connect how that increased demand will attract export of that product from our country. For example, European countries are right now in trend for organic and less processed food. India being second largest producer of all food items, that trend is surely going to benefit agricultural sector of India and also of China, which ranks first in production of food. Though I am not totally an information investor, I think it is the reason why he bought Aries Agro. Similarly, you must be able to connect dots of important news to related sector. It will help you buy the business for possible best price. He makes it clear that management do not talk with average investors, so average investor should not live with idea that they can get information from business about their future plans. On other hand, he advises to not listen to what management says because every time he had listened to management, he suffered loss. This does not happen because management is corrupt. This happens because management themselves are either busy to analyze information or incapable of connecting information to their own business. Some of them end up making and implementing expansion plans which are very much guaranteed to fail because they are unaware of information that can adversely affect their business. So do not listen to management. You can read annual report, but don't be over optimistic on it. Invest only on information that you have in hand. Spoon feeding eventually fails. No one knows the future, so do not invest in prediction. Again, he made it clear that he do not invest in IPO. He needs information about how business performed before he invests in them. Therefore, he says no to invest in them. Finally, he does not bother about market cap. With respect to market cap, he keeps no personal preferences. On other hand, he says a cap is a cap, and if business is capable of delivering profits, size of cap does not matter. After you connect source of information to what industry it can benefit, it is time for you to pick stock from industry that is extremely likely to deliver better profits. Keep in mind, market makes money for you only in bull market. Therefore, it is important for you to buy business that are already performing and wait for bull market to push prices up. During bear markets, be patient and hold your stocks. Sooner or later, market will unlock value. A business worth buying is one which have very good management. A business is having good management can be seen from the fact it manages to perform in spite of its own industry underperforming. A good business does not only have good products but also good branding. It usually holds competitive advantage over other businesses of its industry. While making buying decision, 50% mark should be awarded to good ambitious management, whereas rest 50% marks should be awarded for good product, good branding and competitive advantage. As per him, if you know why you bought the stock in the first place, there shouldn't be any reason why you should not be able to figure out when to sell it. First, keep in mind the number that appears on screen is not your profit. The profit is amount that you will book after selling your stocks. Just like Peter Lynch, he also recommends you to invest in house first and then on anything else. In case there are two options in your hand, from which one is reinvest money and second is buying house, then always go for house if you don't already have one. Every investment is worthwhile only after you have invested in shelter for yourself. As per him, you should sell stocks in 4 scenarios. First, sell if you really need money. Second is sell if the reason for which you bought that stock no longer exists. Third, sell if management loses its focus. As example of management losing focus, he told about his investment in Jayashree Tea. He invested in Jayashree Tea because it was cyclic business and market conditions were favoring its growth. After few years of growth, management of Jayashree Tea decided to expand themselves by entering into sugar industry. Tea itself was cyclic business and then again they decided to enter another cyclic business which from no angle connects to tea industry. From this, he realized management has lost its focus, therefore, he sold his stocks. Finally, sell if valuations are just too good to digest. As example, he told he bought Atul Auto when it was trading at PE of 5, but then sold it when PE became 40. Now I know many of you might be thinking he uses PE as value of measurement. Well, answer is yes, but by no means he is suggesting to buy stocks with low PE. Keep in mind his other investments like Vaibhav Global and Aries Agro Products were about PE of 30 when he bought them. P do can act as value for measurement, but before you use it, be very sure what it really measures with respect to business in question. Finally, let's take a look on Vijay Kedia's outlook on investor psychology. Now, as per him, market is place for regret. It doesn't matter either you book profit or loss, you may end up in regret, and he explains it in a very interesting manner. Suppose you invested your money in stocks. After some time, you end up making good profit. Now stock matches your selling rule. Therefore, you release your position and then prices start rising up. You will regret that you ended up selling too soon. In condition 2, prices match your selling rule and you end up selling your position. This time, rather than rising, prices end up falling. This time you regret with excuse, only if I would be able to sell right at the top. In condition 3, you and your friend invested in stock together. After a year, you both booked good profit on your investment. But your friend ends up with more profit than you. You regret with excuse you made wrong analysis. In general, when you make losses, you regret. You make profit, you regret. You end up selling soon, you regret, and someone else ends up with more profit, you still regret. In this mentality of regret, you can end up making silly mistakes later which may ruin your investments. The game of regrets usually ends up making you blind to unpredictable nature of market. Reality is that you cannot control nature of market. But when market starts delivering profits, 50% of your profit is determined by market with its upside. Rest 50% of profit is determined by you. Either you book it or not is totally your choice. The upside of stock is not under your control is very much evidence of the fact you simply cannot come up with any selling rule that can help you book profits right at the top. In some number of cases, your selling rules are supposed to fail. But for time it keeps you in profit on majority of your investments. Do not question its validity with your games of regret. Throw away your regrets about your profits and losses in gutter. As an investor, you should not be playing that game. Now let's try to understand why Vijay Kedia's investing method works. So let's take a look on some of his investments. First, TCPL Packaging. On this stock he made like 10x gains. Next, Aries Agro. This was bought very recently. Gains are yet to come. Next, Sudarshan Chemicals. Here again he made like 4x gains. Finally, Everest Industries, which again was bought few months ago but is also sitting with solid profits. If you have learned my investing method, then you would have realized that almost all stocks that we saw right now moved up as soon as they matched 52-week high criteria with economic trigger. So what's really happening? Let's start with economic factors. Economic factors are those factors due to which our spending habits change. Economic factors that helps a business earn more is known as economic trigger. Economic factors are interconnected with each other, which means beginning of one economic factor can not only trigger another economic factor but can also kill previous economic factor. For example, let's consider country ABC is planning for a very big project in heavy engineering works. Now for completing these heavy engineering works, ABC will ask for help to other countries. Now India is one of the dominant and one of the most trusted player when it comes to completing international level heavy engineering works. Without any second thought, India will for sure participate in ABC's project. Since project is big, the businesses that will participate in ABC's project will need extra manpower. which will lead to increase in employment, especially in civil, mechanical, electronics, power, instrumentation, and structural engineering. Again, there will be demand for labor supervision. Apart from that, it will also trigger sales in industrial instrument and commercial vehicle sectors. So the economic factor of ABC's project work triggered economic factors of sales in industrial instrument and heavy commercial vehicles, along with jobs in engineering and labor supervision. Now, all these economic factors in their different stages will also trigger other economic factors. For example, employment usually will lead to increase in insurance sales. Again, due to employment, people might start buying products and services on finance. So it can also lead to increase in sales of loans. In general, we can say economic factors are usually interconnected with each other. The economic factor which usually leads to increase in earning power of business is known as economic trigger. Since economic triggers leads to increase in earning power of business, the result is usually formation of a new 52-week high. The difference between how I invest and how Vijay Kedia invests is that I invest at the end of chain when due to economic trigger, prices generate 52-week high, whereas Vijay Kedia invests a lot before chain results in economic trigger, which results in we both investing in almost similar conditions, with Vijay Kedia's preference more on low risk value of stock, whereas my preference set on direction of price, due to which most likely majority of his stocks by default are highly susceptible to be in my portfolio too. But he will always have advantage of getting stock for better price. To great extent, I believe on quantitative analysis front, we must be looking at same things, which includes consistent performance in spite of bad economic conditions. And since result of economic trigger is usually more earnings, cash flow before economic trigger isn't really important, because economic trigger will automatically result in increase in positive cash flow. Now, important question is, if I know Vijay Kedia catches stock at the beginning of chain, then why I don't catch chain myself? Well, answer is chain analysis is not really as easy as explained in diagram. The beginning of chain usually leads to settling down of price volatility, but it is still hard to figure out where chain begins and how it will react later. Identifying trigger phase is easy because it results in new 52-week high. Now, since price is at 52-week high, my risk increases. So to make consistent profit, I depend more on better risk management and strategy than method of analysis that can provide me buy position at lower price. Again, I am a techno fundamental investor, and to invest, I do believe in golden rule of techno fundamental investing, which states technical always follow fundamentals. So if fundamentals are strong, there is extremely high chance it will also become visible on price chart. And all buying positions are very much likely to be similar. So here's TCPL pack. This is 52-week high generated because of economic trigger, and here is chart setup that shows it. First, we get a standard bullish cross, and then there was long-term resistance break. Technical and fundamental match, so it's a valid buy position. Aries Agro, again standard bullish cross along with long-term resistance break. Sudarshan Chemicals, again a standard bullish cross along with long-term resistance break. You ain't really going to see anything different on Everest Industries, Apcotex Industry, or any other stock in which upside is triggered with economic trigger. After fundamentals get strong, it is highly likely that they will appear on chart. Where you buy, how you manage risk, and how you apply strategy finally turns profit for your portfolio. While Vijay Kedia prefers concentrated portfolio, I prefer over-diversified basket approach. So before we end this video, a final word of wisdom. Your success as investor is not decided by superiority of your analysis method. It is decided by how well you can implement whatever skills you have to get better results. With that said, thanks for watching this video and have a nice day.